Right now, it feels like the entire world has decided that AI is the new religion. Your feed is full of people saying the same 3 lines. This time is different. This is the future. You're an idiot if you're not all in. We've heard this before. We heard it in 1999 with dot-com stocks. We heard it in 2021 with crypto. Every time, the script is the same. A new technology, a tidal wave of hype, and a lot of people convinced they've finally found the shortcut to wealth. And yet, there's one voice that never really changes when the crowd loses its mind. Warren Buffett. Buffett barely touches cutting-edge tech. He openly admits he doesn't fully understand most of it. But here's the paradox. His principles are exactly what you need if you want to get rich because of the AI boom without getting destroyed by it. His warning is simple. People don't lose money because the world changes. They lose money because they forget how to think when the world changes. So in this video, I want to do something very specific. We're going to take Buffett's thinking, strip out the 1970s context, and apply it directly to 2026 and the AI boom you're living through right now. By the end, you'll know how to position your money, your time, and your skills so that AI becomes a tailwind for your wealth, not a wrecking ball. And we'll start with the most dangerous shift Buffett sees in every bubble. The moment investors stop acting like business owners and start acting like casino players. Buffett has said for decades that the stock market exists to transfer money from the active to the patient. That line has never been more relevant than it is in the AI era. During every tech mania, something subtle happens. People stop asking, what is this business actually doing? And start asking, how fast is the price going up? You can see this in your own behavior if you're honest. When you hear about a hot AI stock or a new AI token, what's the first thing you do? Do you look up their financials, their customers, their margins, or do you pull up a chart and see if it's already pumping? Buffett's filter for this has always been brutally simple. If you can't clearly explain how the business makes money, why customers pay, and why those customers can't easily leave, you are not investing. You're gambling. AI has made this trap even easier to fall into. Overnight, every company can slap AI-powered on their website. Startups raise money on a landing page and a demo. Tokens launch with no product, just a white paper and a Discord server. Narratives are moving faster than due diligence. A lot of these so-called AI plays have no durable advantage, no brand moat, no switching costs, no history of generating free cash flow, just a story and a stock symbol. Buffett would call those lottery tickets dressed up as investments. So your first rule for building wealth during the AI boom is this: AI is not a free pass to suspend judgment. If you can't sit down and, in a single paragraph, explain how this business will still be throwing off cash 10 years from now in a world where AI is everywhere and cheap, you don't own it. You can watch it, you can study it, but you don't tie your future to it. That one mental filter alone quietly removes 90% of the noise that's draining people's accounts right now. Once you're out of the casino mindset, the next step is to ask a deeper question Buffett has built his entire career on. What actually survives in a world where AI changes everything? Buffett's favorite word is moat, not technology, not disruption. Moat. A moat is what protects a business when the world changes. And AI is not just another trend, it's a force that's actively attacking certain moats while deepening others. Think about all the businesses that only existed because something used to be hard, manual, or gate-kept. Agencies that charge premium prices for basic copywriting. Middlemen whose only job is to move information from one place to another. Generic marketing shops that send the same cold emails for every client. When AI can do 80% of that work in seconds, those margins don't just shrink, they evaporate. If a business has no brand, no real relationships, and no proprietary asset, AI doesn't just compete with them, it exposes them. On the other hand, there are moats that actually get stronger with AI. Distribution moats, platforms that already have billions of users showing up every day out of habit. When they add AI features, they don't need to go find customers. The customers are already trapped inside the ecosystem. Data moats, companies that own unique, hard-to-recreate datasets. The models will become commodities. Everyone will be running some version of the same open-source or licensed engine. The scarce resource becomes the data you feed those engines. Switching cost moats, tools that are deeply woven into how businesses operate. When those tools add AI, their customers don't suddenly leave for a new startup. They just get a smarter version of something they already can't live without. So when you hear AI stock, you have to slow down and ignore the AI label for a second. You strip the story away and ask, what is the moat? And does AI make this moat stronger, weaker, or irrelevant? Buffett made billions by ignoring stories and buying moats. The AI era just makes the stories louder. The rule hasn't changed. Once you get this, the obvious question becomes, okay, so where does my money go? How do I position myself so I benefit from the AI winners without trying to play stock market god? That's where Buffett-style allocation comes in. Once you understand that most AI plays are just stories, the obvious question is, what do you actually do with your money? This is where a Buffett-style structure beats any stock tip. Think in terms of 3 buckets, not one magic pick. The first bucket is your foundation, your sleep well core. This is where most of your long-term wealth lives. It's not flashy. It's broad, low-cost index funds and diversified ETFs that already hold the current and future winners of the AI race. You're not trying to outsmart hedge funds or guess which chip manufacturer doubles next. You're accepting that innovation shows up in the index over time, and you quietly own the wave instead of trying to surf every spike. The second bucket is your AI opportunity sandbox. This is where you're allowed to have opinions, but with guardrails. A small slice of your portfolio, maybe 5 to 15%, reserved specifically for AI-related bets you genuinely understand. That might be a specific AI infrastructure company, a robotics ETF, or a niche SaaS platform with a real data moat. The crucial rule is simple. If this entire bucket went to zero, your lifestyle doesn't change. It's your tuition for learning the game, not the money that pays your rent. Then there's the third bucket. And this is the one most people ignore, your personal AI engine. This isn't about the stock market at all. This is capital, and more importantly, time. You invest into making yourself more valuable in an AI-powered world, learning the tools, using them to launch side incomes, building digital products, automations, and systems that let you decouple your income from a single paycheck. Buffett made his fortune allocating capital into businesses with moats. In 2026, part of that capital needs to be allocated into you, so that no matter which AI company wins, you're positioned to benefit. Buffett doesn't get rich by predicting the future. He gets rich by pricing risk better than everyone else, and then calmly acting on that edge. He does that through insurance companies. They collect premiums now, pay claims later, and hold what he calls float, which are huge pools of money he can invest in the meantime. AI gives you a personal version of float, not in money, but in time and output. Most people see AI as a threat. Is this going to replace my job? That's the wrong question. The right question is, how can I use this to underprice my competition? Imagine you're a freelancer. You used to spend 4 hours writing a great article. Now, with AI as your assistant, you can outline, draft, and refine that same piece in 90 minutes without losing quality. You can deliver more work in the same week at the same or higher pricing. Your effective hourly rate doubles, but your client never feels overcharged. You've just underpriced everyone still working the old way. If you're an employee, the same logic applies. You can quietly take on the workload of 2 people by using AI to handle the heavy lifting on research, drafting, reporting, and analysis. You don't brag about it. You just become the person who always delivers, never misses, and handles complexity calmly. In a layoff scenario, that's the last person they want to let go. If you're building a business, AI lets you slash the cost of content, prospecting, customer support, and operations. The savings you create are your float. Instead of spending that float on lifestyle upgrades, you reinvest it into better product, more marketing, new hires. Your compounding curve bends upward. The key is discipline. Most people will use AI to send slightly better emails and write slightly faster reports. A small minority will use it to reclaim 10, 15, 20 hours a week and then redeploy those hours into wealth-building activities. Buffett uses float to buy assets. You can use AI to create float in your calendar, then use that time to build skills, systems, and cash flow. Once you start thinking this way, the final piece is to guard against the 2 big risks that, in a boom like this, quietly blow people up. Buffett is obsessed with one idea. Avoid the thing that can kill you. Not the thing that makes you look smart, the thing that knocks you out of the game completely. In the AI boom, there are 2 threats that fit that description. The first is leverage wrapped in a narrative. You see it everywhere. People borrowing money to buy AI stocks, AI tokens, AI options, convinced that because AI is the future, it's basically free money. Buffett's view is painfully clear. If your investment only works when you add leverage, it's not an investment. If you're right about the underlying trend, you don't need to borrow to benefit from it. If you're wrong, leverage will magnify that mistake until it becomes a disaster. The second risk is concentration in something you don't control. Going all in on one employer because they're big in AI, going all in on one token because a thread on X said it's the AI infrastructure of Web3, building your entire income around a single platform or a single guru system. AI is moving too fast for that level of blind faith. A regulatory change, a new open-source model, a shift in API pricing, a competitor's breakthrough, any one of those can collapse a business model in months. Buffett talks about a margin of safety. In 2026, your margin of safety looks like this. Multiple skills that are valuable in an AI-rich world, multiple income streams that don't all rely on the same company or platform, and multiple ways to win if a single tool disappears. You're not trying to perfectly time the AI wave. Your goal is to structure your life so that any version of the future where AI gets bigger is good for you, and no single failure wipes you off the board. Once those risks are contained, you're finally in the position Buffett always talks about. You're not praying for stability. You're calmly letting compounding do its work. When you step back from the noise, Buffett's message for the AI era is surprisingly direct. Don't let a new technology talk you out of old discipline. You don't need to predict which model wins. You don't need to chase every token, stock, or headline. You need to do the same things that have always built wealth. Own real value, protect your downside, and let compounding work inside a new environment. That means thinking like an owner, not a gambler. When you see an AI opportunity, you ask what the business actually is, what the moat is, and whether it survives when AI stops being shiny and becomes just infrastructure. It means structuring your money instead of winging it, a core that grows with the market, a small sandbox where you can explore AI themes without blowing yourself up, and a personal engine where you use AI to multiply your own earning power. And above all, it means remembering that your biggest edge is not a secret prompt or a stock ticker. It's your ability to think clearly while everyone else is emotional. So when this video ends, don't just nod and move on. Decide your 3 buckets. Pick one concrete way you'll use AI this week to either earn more or free up time to build an asset. Most people watching will stay in casino mode. If you want to be in the minority who actually build lasting wealth during the AI boom, start acting like the owner Buffett has been talking to his entire career. Most people will nod along here, maybe like the video, and then go right back to scrolling for the next big thing. That's how bubbles feed on themselves. If you want to be in the minority that actually builds durable wealth during the AI boom, lock this in. The real opportunity is not just in AI companies. The real opportunity is in becoming the type of person who can use AI intelligently, patiently, and systematically over the next 5 to 10 years. If that's you, hit the like button. And if you're serious about playing this game the Buffett way, type AI Moat in the comments, so I know you're thinking long-term. Share this with someone who's serious about getting ahead in 2026, not just talking about it. And if you want a tactical step-by-step system for building your first AI-powered income stream, watch the video on your screen next. It gives you a concrete blueprint you can start this week. Make sure you're subscribed to The Money Habit. We don't do hype here. We build systems the smart way. I'll see you in the next one. Thanks for watching. Use AI as leverage and build wealth that survives every boom.